Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hey, the planning you've done to accumulate wealth to get you to retirement has to change once you are retired. It's two totally separate sets of planning. Do you have a second plan once you reach retirement? Do you understand the pitfalls that a lot of people are making right now? Stick around over the next half an hour. Big Al and I will break things out for you to teach you exactly what you need to do. Welcome. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors, and I'm with the big man, as always, Mr. Alan Clopine. He's a CPA. Hey, throughout this show, what we want to dive into are some keys for when you start investing in retirement. Because I know a lot of you, once you are retired, you probably want to jet set the globe. You want to do fun things. But I'm telling you what, once you reach retirement, when it comes to your assets and what you build up, this is more, you got to be more active than ever before because there's a lot of things that can happen. Let's bring on Mr. Clopine to get things started. Big Al? Hey, Mr. Clopine, I just wanted to see if they were tight to see, forget about what's on my mind. I want to do right now, my friend, away.
Just right now. You know, it's funny, the weeks blend together. It seems like we just did a show on Social Security. I don't know why, but at any rate, today's show is on the keys to investing in retirement. And a couple things that we want to talk about that you really need to consider, whether you're in retirement or close to retirement or just thinking about retirement. And I guess number one is to kind of figure out what your target is. What are you trying to accomplish? What kind of lifestyle do you want to live? Know what you're shooting for, right? And then number two is look at your income sources, whether they be from Social Security, pension plans, IRAs, 401ks, what they might be. Then, are you on track? Let's look at a growth plan, how to figure out a growth plan to make sure that you'll get there, that you want the lifestyle that you want. And then what about investing? I mean, how should you go about investing? Is you want to go with the latest fad or trend, or is there a more disciplined approach? And then finally, asset allocation. Sounds a little boring, but did you know that over 90% of your rate of return has everything to do with what assets you have in your portfolio, not the stocks that you pick? So that may be news to some of you. And Joe, this is a great topic for trying to figure out to retire, because it's not just do I have enough dollars, but it's what do I want to do in retirement and how I'm going to make that work.
Right. I mean, there's two separate sides of the coin here, I guess, with anything in life. And then when you try to accumulate, most people like shoot for a number, or maybe it's an income, right? And so what we want you to do is just look at a target. What's the lifestyle going to be? What do you want to do in retirement? What is that overall game plan? Do you want to jet set the globe? Do you want to surf every day? What type of lifestyle do you want in retirement? Do I want a better lifestyle, or are you going to tone things down? And can I get by with less? I mean, those are some very serious questions that you want to make sure that you start with. I think most people want to spend a little bit more in retirement. They want to do different things because, hey, you've been working for the last 20 or 30 years. There's different things that you might want to do. That is the first step when it comes to an overall game plan in retirement. Then from there, then you can dive in to say, all right, well, what differences do I need to do with the overall cash that I've accumulated to make sure that I don't run out? Because that's the biggest fear, Al. When you look at people that are approaching retirement, you ask them, what's the biggest fear that you have? And guess what? It's running out of money. You don't necessarily want to run out of money before you run out of breath. You have a game plan to make sure that that doesn't happen.
Well, you're right. And what's the latest survey we saw? I think 22% of you would rather die than run out of money. Let's not have that happen to you. So it is. It's all about what kind of lifestyle you want and planning for it. And if you really don't know, start with your current lifestyle. That's at least a good place to start. And some of you are going to want to spend more. I can tell you that right now, because you want to travel more or more time for hobbies or whatever it may be. Others of you may be just fine with a reduced lifestyle, so that's up to you. But I'll tell you what, in terms of once you figure that out, then you got to do a little bit of basic mathematics in terms of how to figure out whether you're on track. So, for example, let's say you take a look at your expenses and they're $70,000 now, and that's what you want them to be through retirement. Take a look at your Social Security benefits, maybe $30,000 in this example. So then you got a shortfall. You need $40,000 from somewhere, and that's okay. That's why you're saving money. Now take that shortfall Here's a quick tip. Multiply that by 25 to get the approximate amount of savings that you need to make this work. And that is really just a rule of thumb. For some people, it will be a higher number. Some people will be a lower number. But that's at least a starting point. And Joe, what we see is that most people we talk to have not even done that very simple step to figure out if they're on track.
Yeah, I mean, that's key. Then that's going to tell you, are you on track, not on track? Do you need to save more? Are you financially independent? Are you willing to give up your paycheck today because you have enough assets to create your own paycheck? But that's just the start of it, because here's a really interesting statistic, is that if you take a look at where most of the retirement assets are held, there's $24 trillion sitting in retirement accounts. If you look at IRAs, defined benefit plans, defined contribution plans, government pension plans, annuities, and so on, if I add up all of those dollars, it's $24 trillion sitting in these accounts, ready to get tapped in to create the income for retirement. But guess what? All of those assets are taxed at the highest of rates, ordinary income. The bulk of the savings are in these retirement accounts. So when it comes time to start creating that retirement income, either from your IRAs or your 401ks, just know this, you might need more, because every dollar that pulls out of there is going to be taxed at the highest of rates. And I think the IRS, Al, is pretty excited right now, because you've got a lot of baby boomers that are facing retirement. Most of the assets that they've saved are in these retirement accounts, and then they're going to, once they start tapping those in, they will pay very high taxes.
Yeah, you talk about this, $24 trillion. Most of that is in retirement accounts where you're going to have to pay tax when you pull the money out. Now, maybe a little bit of it is in a Roth IRA, but most of it is fully
I mean, given those
taxable.
dollar figures, maybe a couple of dollars are sitting in a Roth.
And get this, the baby boomers are getting older, and at 70 and a half, you have to start taking money out of that 401k, out of that 403b, out of that IRA, whether you want to or not. So you are right, Joe. The government is just getting ready for this.
Right, and they're pretty excited. So you want to make sure that you protect your wealth as much as you can. Like we said before, you want to look at a target. What are you trying to do? Do you want to expand your lifestyle, reduce it down? Are you going to stay in California? Are you going to move to Idaho? Whatever, figure that stuff out, and then you take a look at, well, how much money do I need? Then from there, then you have to assess, where is the money held? If it's in retirement accounts, just understand that a big bulk of those dollars are going to go to the IRS in a form of taxation. So you have to get a plan in place, so stick around. Over the next couple more minutes, we're going to get into what that plan should look like, how should you invest your assets, what's the allocation look like, and so much more. So do not go anywhere. The show's called Your Money and It's Your Wealth.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know, according to the Federal Reserve Bank, the national savings rate hovers around 5%?
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al Clopine hanging out. Good morning, everyone. Hey, what we're talking about today is really identifying some different things that you need to do to have a successful retirement. Some of the planning that you've done, you might need to change it and revamp a little bit of what you're currently doing, because the money's going to last you a very long time. So there's simple steps and keys to make sure that you have a successful retirement. Before we dive into all of that, let's go to the true-false question.
The best time to grab long-term care policies is after you retire.
I don't know, we grab. Dude.
Let's grab the policy.
You just grab a policy. I don't know, maybe. I mean, the longer you wait, if you're looking to protect yourself, you know, from a long-term care stay, there's all sorts of different long-term care type of planning. Sure. You might want to self-insure. You might want to just lean on some family members, or if you want to insure it and transfer the risk to an insurance company, the sooner that you buy the policy, the cheaper it's going to be.
Sure, but wouldn't you say, what, 55, 60, that's the age to kind of think
about
I mean,
I know individuals that have purchased it in their 40s.
I know, but I do too.
Right.
But just in general.
I would say, I mean, probably, if you take a look at the break, 50 for sure. Who knows? I mean, it all depends on the underwriting, what health that you're in.
Yeah, the point that...
I think the sooner that you look at it, right, the better off you're going to be to decide what type of plan that you want to go into.
I agree with that. And whether you may not want to wait till you retire. That's the whole point. So the answer is false.
Right. If you wait until 65, 67, or the cost might be way too expensive that you could afford it.
Yeah, right.
You know, when you look, if any of this is confusing, right, there's a lot of things things that you want to make sure that you take a look at to have a successful retirement. Do you have enough money? Do you have a plan in place? And if you don't, guess what? You're not alone.
Looking forward to retirement, but not sure you'll make it pencil out.
Human beings, I think we have very few instincts, but unfortunately one of them is procrastination, one of our strongest instincts. And so I think that's really important, is just get started as soon as you can.
Regardless of your age or how much you've saved, there are moves you can make to improve your retirement picture. Setting up a plan and a budget are the first steps.
The key is, in retirement, you don't have to be wealthy to retire. A lot of times you just have to spend less than what you've earned. And that's kind of the basics, I think. You go back to that, make sure you control your debt early on. And I think, as long as you kind of build up your emergency reserve, enough cash that you know that is not there to earn a rate of return, but it's there just for safety, then you can start addressing how much extra do I have to either give to my Roth IRA or my 401k.
To catch up, make the most of your multiple accounts. If your employer matches your contributions, try to max out the contributions and take advantage of catch-up contributions.
Just start an account, whether it's a Roth IRA or your 401k at work, because that automatic contribution, you kind of forget about it. And a lot of times after a few months, you've gotten used to not having that extra $50 a month or $200 a month, and you live with it.
Avoid taking big investment risks to make up for your retirement fund shortfall, and hire a financial advisor to help you stay on track.
The implementation of any idea is really where the rubber meets the road. And if you don't have somebody there kind of coaching you a little bit as you go along and keeping the end goal in mind, because sometimes it's easy for us to sway and kind of get short-term in our thinking, that I think it's that having that coach that to push you and to give you the confidence that you're on track.
For Your Money, Your Wealth, I'm Lynn Stewart.
A lot of different things in that clip, Al, is that, I think the most important thing that people need to do is get a target in place and just start somewhere.
I do too. I think that's the big miss that a lot of people have, is they think, you know what, I'll do this tomorrow, I'll do it tomorrow, I'll do it tomorrow. And you know what? Tomorrow is here today. So
right. Yeah.
Got to do it now.
Good point. And being disciplined is key, because let's just take a look. And here's something that I encourage a lot of you to do, is to get that plan in place. And here's just a quick, simple step of what you want to figure out. Let's say this real quickly. I'm 52 and I've saved this $500,000. And I want to retire at age 67. I got to figure out, okay, well, maybe that's the number that I need to accumulate, or that what my nest egg needs to grow to over this time period. You want to make sure that you figure out what this number is. Then you can back in your target rate of return. So for instance, this is a 6% growth rate. Then you can manage the assets appropriately to make sure that you can identify that 6%. Of course, some years you're going to get a lot higher, some years you're going to get lower, but if you target that 6% growth rate, hey, you're going to be more apt to accomplish your goals. And I think, Alan, when people look at investing, right, they might just follow the trends or try to get the highest rate of return possible. But if you understand, if I'm trying to get the highest return possible, I'm taking the most risk possible. And once I'm in this red zone, if you will, it's very difficult to recoup or recover as soon as you start making really bad mistakes with the money that you've accumulated.
Well, Joe, that's exactly right. And just to even take that example one step further, if that individual was saving, let's say, $30,000 a year, the balance would be close to $2 million. And I find it interesting to see that, the first 25 years, let's say, a savings, $500,000, the last 15 years, now it's up to $2 million. It shows you the power of compound money. But you also got to know how to invest it. And here's our tendency. Our tendency is to watch CNBC or whatever magazine we want to read. We want to pick the best stock, the latest stock tip. Maybe we want to go all in emerging markets because it did well last year. Well, that's what we call trend investing, and that really is not a good way to invest. It's really much better to have a disciplined approach, Joe, and I think if people would just follow a more disciplined approach, they'd be a lot more successful in their investing.
Your investing should be boring. Right? If you want excitement, take a little bit of money and go to Las Vegas. You don't want to do it with your overall retirement plan, but a lot of you are. We've had a nice big bull run in the overall stock market over the last several years, and guess what? Maybe a lot of you might be taking on more risk than you should. You want to find that target rate of return. Just real quick, simple points. You want to save as much as you can on a regular basis. Right? Save as much as you can and continue to save those dollars. most of us need to be invested in stocks and in bonds. What Alan talked about, this is called an asset allocation approach, how much money you have in stocks versus bonds. Over 90% of the variance of your returns is going to be based on your asset allocation. It's not necessarily timing the market or investing in particular stocks. We look at what is the highest probability of success. So you have to start with that target in mind and make sure that you take the least amount of risk possible to get that target rate of return. It could be 4%, 5%, 6%, and so on, right? You want to make sure that you take a look at costs, okay? So there's low cost, there's high cost, there's medium-sized cost. You know what? Yeah, this is a factor because that could be a huge drag on your overall return. Unfortunately, the financial services industry is not very transparent. You don't necessarily understand what you're paying. And a lot of you that are watching this right now, if I asked you how much are you paying in your overall 401k or in the investments that you're choosing, you might say, I'm not paying anything. Maybe because you're not paying an upfront commission, but there's always cost fees associated with any type of investment. You just want to identify them. And then rebalancing. This is key. A lot of you need to start rebalancing your portfolio right now. Because if you look at the big bull run, right, you might have started with 60% stocks, 40% bonds, but now because the markets are up over 200%, you might have 70, 80% in stocks and 20% in bonds. In my opinion, as you're approaching that retirement date, that is taking on way too much risk in the overall portfolio. It might look good on your statement right now to say, hey, look at these great returns, but we all know what goes up must come down. You want to make sure that you hedge against that. Hey, stick around. We got a lot more to go. So you are watching right now. What is it? Your money, and it's your wealth. Hey, welcome back. Welcome back. Good morning, everyone. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine, hanging out today talking about keys to successful retirement. So some of the things that you need to take a look at when you are retired. Hey, let's go to the true false question. What do you think about that, Big Al?
Like it. Annuities should be part of most retirement account portfolios to guarantee income in retirement. What do you think, Joe?
No, I don't think so.
You think no? You can elaborate?
Here's what people need to take a look at is that you want to look at all the guaranteed income sources that you're going to have, such as Social Security. Maybe some of you might have pensions. Those are guaranteed income sources. Then there's other type of investments that you can invest in, all right, that will give you some sort of income. You can invest in stocks and look at dividend. You can invest in bonds and get a coupon. You can invest in real estate and get income from that. Or you can look at a packaged product either through an insurance company or a brokerage firm, such as an annuity. Annuities, there's commercial annuities that some are good, some are bad. You want to make sure that you really understand exactly what you're getting into when it comes to some of these products. Most people want a guaranteed income for the rest of their life, but just know this, that you want to look at the fees, the cost, and what you're really getting inside of those annuity contracts. So there are some guarantees when it comes to any type of insurance, right? And so, yeah, there's some pros, but in my opinion, there could be even more cons. So you just want to do your due diligence and do a little bit more than just kind of taking those products on the surface. How did I do with that, Al?
Yeah, I would agree with you. And really, I mean, when you think about it, the annuities, a lot of them, not all of them, a lot of them have very high costs internally. So what that means is that each and every year, you're paying a lot of what could be your earnings back to the insurance company. And have you ever noticed the insurance companies are in the biggest and best buildings in each city? There's a reason for that. It's not just annuities, but that is one of the reasons. So just be careful. A lot of times there's a lot of smoke and mirrors in these products. Make sure you understand what you're buying.
All right, let's look at keys to investing in retirement. First thing that you have to do is you absolutely need a target, all right? So you want to figure out, all right, well, how much money do I want to maintain as a lifestyle? Is it $10,000 a month? Is it $5,000? Is it $2,000? And then do some inventory. You want to take a look at where your other income sources are going to be from to hit that target. How much are you going to receive in Social Security, in pensions? How much assets have you accumulated? And make sure that you have that growth plan in place. It's very, very important. Then you have to take a look at your investing. How are you investing right now? Are you looking at the trends? Hey, stocks are hot. Let's continue to ride the train. Or do you want to be more on the defensive and saying, hey, you know what? I got to protect everything that I built up because I can't run out of money. Then you have to take a look at your asset allocation, how much money that you have in stocks versus bonds. And then you want to make sure that you rebalance that overall account. Because if you take a look at the academic studies, your asset allocation could be the most important component of your overall investment strategy. You want to make sure that you have a solid game plan there when it comes to creating that retirement income. Hey, Al, let's flip the show to our viewers and let's get into a few email questions. We got a few good ones today.
Let's do that. And I think the first one is from Claire in San Marcos. And she writes, my dream is to have a second home in Palm Desert in retirement, but my husband insists that it will cost less to stay in nice hotels. What advice would you give us if we want to stay in the desert 3 months out of the year? Oh, this is a great question. We get this one all the time. And I guess I can sort of start this, Joe, because I have a vacation home in Kauai, the island of Hawaii. And I love it. So, but I'll tell you this, it's not cheap, it's expensive, but what we do is when we're not there, we rent it out. And I would say, Claire, if you're willing to rent out your vacation home, it's much more viable. But most people aren't. Most people don't really want other people to stay in their homes. And so if you're just gonna stay there for 3 months and have it vacant for 9 months, I think I'm gonna side with your husband. I think nice hotels would probably be cheaper. Although, staying in a hotel for 3 months, I'm not sure you wanna do that. Maybe you wanna rent a condo for 3 months, so you have a kitchen and all that sort of thing. But yeah, I would say it kind of boils down to that. If you're willing to rent your vacation home and the numbers work out, the cash flow works out, I'd say go for it. If not, then just rent when you get there.
Yeah, I don't know. I would disagree. I would just look at, all right, well, if it's your dream, you got to take a look, can you really afford it? I think a lot of times people will get their second home. They might not utilize it. It's an added huge expense to the overall bottom line when you're in retirement. So I'm against it, Al. I would say just find a cheap Motel 6 and then hang out there.
That's what I said. So we are in agreement. Anyway, here's the next one. This is from Jill in Bay Park. And she says our son wants to borrow money to buy a home. To loan him money, we would have to sell stocks and bonds outside of our retirement accounts. Is it better to sell stocks or bonds? Wow, that's a loaded question. And I would say, first of all, do you really want your son, do you really want to finance your son's property? I mean, so consider that. I'm assuming your son's going to get a loan, and maybe this is for the down payment. And assuming that you want to help with the down payment, then you basically just have to take a look at your investments. If you sold stocks, if you sold bonds, which is going to create a bigger gain? You don't really want to necessarily create a gain, and so you sell the one with a lower gain. Or some of your positions may actually be in a loss position. Maybe you sell those to create a loss that you can use those losses against other gains.
Yeah, I mean, I think it always boils down. I think one of the biggest mistakes that people make in retirement is that they're still funding their kids. We see the statistics that a lot of you are still paying your adult children's cell phone bills. Yeah, it's great to help them out, but you want to make sure that you take care of your retirement first and then take a look at, all right, well, what's the next step? Now, in regards to selling one asset class, all right, well, stocks have accumulated in overall price, so it might make sense to sell there. But as Al noticed, he's like, all right, well, that might cause a gain. Now you have to pay taxes on it. So are you first prepared for your overall retirement? Then second, you want to make sure that you take a look at the overall positions that you currently have. All right, do you have some at a gain? You sell those, you pay the tax. Just understand that you will be giving your kid a little bit more money because of the taxation on it. So, yeah, I'm with you. That's kind of a tough question without knowing a lot more.
Right.
But first take care of you, and then from there, just take a look at all the positions that you have. I don't want to sell anything that's down, right? Because, or unless you're going to do some tax loss harvesting, and that's a totally different topic, totally different show.
True, it is a different show. Joey, I think we have time for one more quick question. And I think this is from Philip in Kensington. I inherited $800,000 from my parents' retirement account. Can I use the money now, or do I have to roll it into my own retirement account? Joe, this has gotten you written all over it.
Yeah, good question, Philip. No, if you want to use the money, you can. You absolutely cannot roll that money into your own account. Here's the rule. When it comes to inheriting retirement accounts, You just inherited $800,000. Make sure that the titling is set up correctly so it still stays in the deceased's name. You are just now the beneficial owner of it. So no matter what your age is, you can tap into those accounts as long as the titling is set up correctly. For instance, if I were to die, it would say Joseph Anderson deceased on whatever date that I died for the benefit of Philip. Right, so now you're the beneficial owner. Here's the caveat when it comes to inherited retirement accounts. You will have to take a required distribution based on your life expectancy. So if you're 20, 30, 40, 50, it makes no difference. You still have to start pulling money from the account. The IRS wants to recycle that money to get it back into the system. You cannot roll it into yours and continue to defer all of that growth. You will have to take a required distribution. You could pull all the money out if you want, pay ordinary income tax. There is no 10% penalty, even though you might be under 59.5. So yes, you can use the money. Well, should you? Probably not. Let that thing continue to defer. Take out only the required distribution, and now you have a real nice big fat nest egg for your overall retirement. Woo! That's it, man. For Big Al Clopine, hey, you know what? I'm Joe Anderson. I want to thank everyone here at the UT. Tiffany's a phenomenal director. We got Adrian here. He's working, you know, the things that I look at. What are they called? Cameras. And then we got, of course, Ty Lynn. We got Michael back there. And, of course, the man, Manny. Want to thank everyone so much here at the UT. Have a wonderful weekend, everyone. You just saw another episode of Your Money or Wealth.